Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day. Today's stock is going to be Alphabet. We'll discuss should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest. Today, we have a plethora of earnings that are coming out in the tech stocks. Last week, we had a few of the Fangs stocks in general, which Fangs stands for Facebook, Amazon. Well, Amazon's going to be coming up, Netflix, Google, et cetera, et cetera. So this week, we have two of the big Fangs that are going to be announcing earnings. Tonight, we're going to be looking at Google. They're going to be announcing earnings, and we're going to do a little bit more of an advanced play here for the stock play of the day that we don't talk about very often, but we're going to have a little bit of fun with it. And then on Thursday, we're going to have Amazon, and Amazon always announces on a Thursday, which means for the option trader, it's fairly interesting in that you're going to have an expiration that has exactly 1 day remaining in it because they're going to announce after the close on Thursday, and then the underlying trades all day on that Friday. So since we're doing the stock play of the day on a Tuesday and Google's going to be announcing tonight, we're going to basically talk about Google just for that reason. And we're going to look at a speculative trade in Google. And I usually would say around earnings, they're almost always going to be speculative. You're going to try to manage your risk a little bit by using the option contracts, but we're going to get a little bit advanced here for the stock play of the day. A lot of times we'd like to just talk about buying deeper in the money calls, selling shorter term calls against those positions, just flat out long call spreads. But today we're going to look at a skip strike butterfly. Now, don't get all scared about it. I'm going to show you exactly how a skip strike butterfly is very similar to doing a short call spread overall. So we're going to be bullish on Google. We're flipping a coin. Nothing's meant to be a recommendation as usual here on the stock play of the day. We're just trying to learn. And if I'm going to speculate on these higher price stocks, it makes option trading quite a bit interesting in that you get so much premium just from the fact that it's a very expensive underlying like Google is, or Alphabet, but we'll call it Google from this point forward. GOOGL is the symbol that we're going to be using today. And then also you get the bump up in implied volatility. And with the addition of weekly options, now you also have all that premium and all that time in those option contracts, and it's got to go away by Friday, right? Because we have weekly option contracts, we can choose to pick that expiration. So with that said, let's talk a little bit about the markets. Now, the story as of late is the TNX. I have my VIX watch list up here, and I'm going to talk a little bit about the VIX, but the fact that the interest rate, the TNX, after last week's Fed meeting, I think it was last week, where they were being trepidatious with their words as they usually are, but there was nothing that necessarily spooked the marketplace. The marketplace is a little worried about raising interest rates too fast, too soon, and we see the 10-year actually kind of spiked up a little bit. We saw it above the 1.8% level, and this is actually the SIBO interest rate index. So if it's 18, that means that the 10-year is at 1.8%. But it actually came back down a lot after the Fed spoke. We got down below the 1.8% level, but we're hanging there. So the market has kind of stabilized as far as interest rates are concerned on the 10-year, which is probably the most looked at interest rate overall. And we also saw the VIX come back today. And we had a wild market so far this morning, but we see the VIX right now at about 2362. And one thing that I want to highlight, and I have my VIX chart up here, is since the big downturn a couple of years ago, we're coming on a 2-year anniversary of the downturn caused by the pandemic. We saw that huge spike up in the VIX, up around 85%. Now I'm highlighting, though, this 40% level. we haven't came back and breached it except for this area right here, right recently after the pandemic. We breached it, but we didn't stay there long. We touched it again. When is this? This is October of 2020, but we haven't gone back to it since. And when we had the downturn, we ran up to about 39 on the VIX, right around the 39 level is where we stalled out. And then we quickly came back, hung out at the 30 level, and now we're back to about the 23% level. And to me, this, when we couldn't breach through that 40% level, to me, that was the marketplace saying, well, the sky isn't necessarily falling. We're a little bit nervous, but we don't need to go down into our fallout shelter at this point in time. The VIX gave us a little, that showed the angst in the marketplace, but it just really didn't break out to above that 40 level, showing that there was a ton of panic in the marketplace. The Fed has came and settled a lot of people down. Still, inflationary concerns are driving the market overall. And if we look at the charts for the first time in a long time, we see some bearishness, particularly in the S&P 500 index. The NASDAQ has looked a little worse overall, worse for wear. We're having a lot of NASDAQ earnings coming out, seeing companies increasing dividends. There's a lot of good things that are happening in the marketplace. But if I look at our SPX chart here, what we see here, I had a trend line that we broke through. And when we broke through hard. You could say this is, and we've talked about moving averages before. I tried to get rid of those little thing, but we had a death cross here in that we had the 20-day moving average cross below the 50-day. And the 50-day moving average has been a line in the sand for the SPX for the last couple of years. It's been very hard for it to break down below that level and maintain that breakdown, or as far as the S&P 500 index is concerned. But recently, that has not been the case. Not only did we break through that, we broke all the way down, broke through the 200-day moving average. And I think it's a solid sign that we had this breakout above the 200-day moving average. But right here, there was a lot of nervousness in the marketplace. This is when the VIX ran up to that 30% level. We're feeling much more comfortable about the marketplace right now, just in general, all the signs. But it is a, people are thinking about value a lot more. And one of the stock that we're going to talk about today is Google. And Google is actually one of the better priced FANG stocks on a PE ratio, trades about 24 times earnings. On a valuation perspective, relative to the other stocks that are mentioned that are all announcing earnings within the next couple of weeks, Google is actually one of the better priced stocks. And you could also throw Meta in there, or also known as Facebook, FB overall. Those are two of the stocks that trade at decent valuations. Okay, so with that said, we kind of like this little break back above the 200-day moving average. We'd like to get our ducks in a row again, where we got the 200 below the 50 and below the 20. Don't put a lot of weight in the concept of the death cross when it's only on slower moving averages. It will happen more often. We break through the 200-day moving average with this 50. Now, that would be a concern overall. I think it means it takes a little bit more weight when you have the 50-day breaking through the 200-day as far as moving averages are concerned. Okay, so with that said, the story isn't necessarily about the long term in the marketplace today. We're going to do something a little bit fun. We're going to get a little bit speculative inside the options playbook. And we're going to talk about a strategy that we don't talk about very often in the stock play of the day. We're going to look at Google. And Google looks a little bit about like the market overall, right? This, don't blink your eye, but this is Google. This isn't the S&P 500 index. Once again, we had to break down the death cross, bounce back, tried to get above the 20-day moving average, couldn't do it, broke below the 200-day, and now we broke back up again. So once again, markets are looking a little bit more stable overall. This looks a little bit like the market. We're going to get bullish on Google. Not necessarily because of valuation or just the feeling of the marketplace in general. We're really just flipping a coin here because we're going to do a speculative trade. We have no idea what they're going to say as far as earnings are concerned. So how do we manage our risk and still participate in this market move? Now, on the upside, like all the way up here around the 3,000 level, obviously that would be a very interesting spot for Google to get to. That's quite a bit out of the money at this point in time. So we're going to target this range and put my cursor right around the 2,900 level. And the reason why we're going to target that is it's going to be a little bit based off of where the chart is at. This was high. If I go all the way back to what this is August 31, where we touched this level. I think that this would be a range that you could target based off of where the chart is at. There's a lot of noise right around that 2,900 level. And we're going to have a little bit more risk than we normally do on the stock play of the day. We always usually look at a one lot contract. In the butterfly case, it's going to be a 1x2x1. That's considered one unit as far as trading is concerned. And we're hoping that we get a bounce back. But if we don't, and the market stays flat or goes down, we'll still be profitable on this trade. Our only real risk here is going to be if Google blows away the marketplace and skyrockets well above the 2,900 level. Okay, so let's get to the trade. I talk a lot about the strategies. Now, the chat box is open up. Feel free to ask any questions. Like I said, this is going to be a fairly advanced trade that we're going to talk about today. So if you have any questions, please feel free to put them in the chat box, and I'll try to address them at the end of the show. Here we go. All right, so here's Alphabet. Symbol that I always use is GOOGL. I don't quite know exactly why I would go with that one versus the other Google stock, which is GOOG, but I think they both trade very similar. It is up today, so we're at 27.25, so a nice round number right now, up about 1% on the day. We're going to look at the nearest term expiration. Once again, we're going to use short-term options because there's a lot of juice in the marketplace. We don't need to go longer in time. There's a lot that we can do because we have an expensive underlying, which increases option premiums just because they're insurance products overall. The more expensive the underlying, the more expensive the insurance would be. And that's basically what an option contract is. We have high implied volatility. It's trading at about a 67% implied volatility. Normally, Google would trade around a 25% implied volatility, but because of earnings, we see this high growth. So we always start when we're looking at a speculative earning trade, trying to get a feel for what the marketplace thinks that that Google can move. So if I go in and I click the at the money straddle, which means that we're going to be buying a call and we're going to be buying a put, okay? And I'm going to clear these out right away because it's going to screw up my strategy a little bit. But if I buy that call and I buy that put that in there, come on. That would tell us what the long straddle would be. And I've already done this. I've already done the math on it. The math is we're looking at about 136-point move. So that sounds like a lot, right? But on a percentage basis, Google is looking for about a 5% move overall. Not huge for Google. It's a little bit normal. Apple and Google usually have an expected move right around 5%. Amazon's a little bit more. I actually did the math on Amazon. Amazon is actually it's just a little bit more. It's about 5.4% is the expected move on Amazon on Thursday. Also, I should mention that we do have Facebook is announcing tomorrow. AMD is announcing this week, and also PayPal. So a lot of big tech stocks are going to be announcing this week just overall. All right, so let me scroll down, close this out, remove this option. We'll do it right here. Okay, so the trade that we're going to look at today is called a skip strike butterfly. Now, people have talked about it as a broken wing butterfly. I like calling it a skip strike butterfly because we're literally skipping the strike of a standard butterfly. Now, I'm not billing this as an alternative to a butterfly. What we're going to bill this as is an alternative to a short call spread. So a lot of times people will look at this and say, I don't think the underlying market is going to move as much as expected. So I might sell a spread to try to capture some of the premium around earnings. And if you do that, you're selling the more expensive option contract. The stock would be somewhere down here inside the options playbook. It would be somewhere down here. This is the profit and loss graph. This is the stock price. And you hope that it does not come up to strike A and go beyond strike A after the earnings announcement. If it goes to strike B, well, you're at your maximum risk, and that's the maximum that you can lose on that trade. But our whole goal here is to get this done for a net credit to the account. Now, what the skip strike butterfly is doing is we're selling this short call spread. We're selling that call spread, hoping to pay for a standard butterfly. So you see, you have the risk that a short call spread brings in, but you're bringing in a hedge. You're bringing in a little bit of protection. You're giving up a little bit of the credit that you would receive. And you're saying, well, okay, if it comes up to the short strike by that expiration, I'm still okay. Because I have this small little range in here where I'm actually going to do better on this trade if it finishes somewhere between strike A and strike B. We're not going to buy strike C. That would be a standard butterfly. So we're skipping that. That would also be the one that we'd be selling if we were doing the short call spread, would be strike C. So hence the name skip strike butterfly, because we're skipping this. We're embedding a spread, a short spread inside this to help pay for the butterfly. And when you have expensive options and you have high implied volatility, a lot of times you can get this done for a decent net credit to your account. And that is what is being shown right here. This means that if I'm wrong on my forecast, anywhere below strike A, I will still be profitable on this trade. Anywhere below that, we're going to go way out of the money, and we're going to look at this trade. And like I said, this is something that I've talked about a lot on my podcast, Options Playbook Radio, but I very rarely talk about it here in this venue on the Ally YouTube channel. All right, I'm seeing a few questions. Hello, everyone. Hey, Wayne, how you doing? So please make sure you add them to the chat box, and I will address them in a second. Okay, let's run to the Ally Invest option chains before I run out of time here. All right, so in this instance, if we did the short spread, we'd bring in more of a credit, but we're going to be able to do this skip strike butterfly for a net credit of approximately $1.05 to the account. And here's how we set it up. We're going to go way out of the money. Like I said, we're targeting the 2,500 range. We said the expected move was around 136 points to right around 5%, a little less than 5%. That would be if we added 136 to approximately where the price was at when I did the math, which was 27.37. We're looking at about 22,867. All right. So the marketplace thinks that that's a feasible, and I'll round off to that. We'll say 2870 because it's definitely not an exact science, but that's kind of the line in the sand. Now, the people or the marketplace has no regard to direction. They're just saying that a potential move, this is the over under on the move, is right around 136. So we want to go above the 22870 strike. We're going to go all the way up to the 2,900. Now, why is that? We're bringing in a net credit to the account. If the market does not get to 2,900, we're still going to bring in that net credit. But our risk is basically where we would skip that strike and add in that short spread. It's a 15-point wide trade. So our maximum risk on this trade is going to be $1,500 minus the credit received in. We'll call it $1,400. So $1,400 is your maximum risk on this trade. If you put this on, you have a higher probability of success. Right now, if we just look at the delta on the 2,900, here's the delta column. It's saying there's a 15% chance that Google will finish at least 1 cent above this strike. We go all the way down to the strike that we're skipping, which is the 2,930. They're saying there's 11% chance. Now, there's a big wild card in here, and that's earnings. So 11% chance isn't zero. I just want to emphasize that. Think about a weather forecast that sometimes they say a 10% chance of rain, and how many times do you think that it does actually rain? Why? Because it wasn't zero. It was a 10% chance of it happening. So in this instance, we look at this, probabilities are fairly low that it will get above this strike price by that expiration date. And that's where my risk comes in. Okay, let me highlight that using the Ally Invest profit and loss graph. And we see this is where the stock is at. Got the big earning announcement today. The dotted line is at expiration, what it would look like. right now with the pumped up implied volatility, if the stock ran to your strike, to that short strike or to that long strike, you would actually be down on that trade. But now let's put this all the way down to 0 days to expiration. And that would be Friday, right? And now with 1 day remaining, you start to see that this is profitable the whole way, all the way up to the 2,900 level. And then if it goes from 2,900 to 2,915, that's an ideal scenario. You could make the maximum on the trade, which would be the 15 points, the width of the spread of the long spread inside your butterfly, plus the $1.05 that you brought in. So you have a $16 upside. Now, ideally, if we come anywhere close to this level, we're just going to close it out. We're going to have a decrease in implied volatility. We just want to get out of that trade because our risk, if it gets up to the 2930 level, which is right about here where we're crossing this little break-even point, when we get up to about that level, that we have a lot of risk on this trade, and we just want to close it out. So what's our max risk here is that Google opens up basically 1.5 times its expected move. It moves 1.5 times more than expected, and it happens right away, and you don't have the opportunity to react. That is our biggest risk here. We have 3 different scenarios where this could be profitable. Now, we have earnings on a stock like Google, never know what could happen. But we have 3 different scenarios. If stock stays where it's at, the stock kind of goes up, the stock goes down, where this trade would be profitable. We have a small hedge by the fact that we have this butterfly inside the trade. And it's just a very interesting way to look at this trade. Now, the risk is substantial. You're looking at bringing in a dollar and you have $15 or 15 points worth of risk based off of the risk profile of the strategy. So if you do get that open and Google does open over 200 points and you can't get out of the trade, well, then you have that risk. And I'm going to emphasize this. If Google were to open right at our short strike, which would be ideal at expiration, just close it out right away. You may be down on the trade. Just close it out, get out of the trade and move on, because you do not want to take on that risk if the stock does get all the way up to the 2950 level, which I'm highlighting here with my cursor. Okay. So an advanced trade, an interesting trade. We'll have a very interesting stock play of the day overtime on Friday, because we'll know where Google landed at overall. This is a speculative trade in Google. Sometimes you have enough volatility and enough premium that you don't necessarily need to do a strategy like this around earnings. You could actually just do it on a weekly basis. And we've talked about that sometimes inside my podcast. I find it interesting to do it because we can get so far out of the money around this earnings report and still bring in a decent net credit. And the only time that you can really do that is around earnings. Once again, emphasize it's a speculative trade and that it's not meant to be a recommendation overall. Now, I do see some questions in here. One of the questions is from Wayne, and he's talking about the midday market call, which is on Mondays. Going forward, we're not going to do the midday market call, which was on our Zoom platform on Mondays, because I'm taking over the stock play of the day. So we're going to kind of turn the stock play of the day into more of an option focused piece. And I will bring in some guest speakers from time to time. We'll still have Lindsay Bell on, which I know is a fan favorite overall. Well, every once in a while, we'll still bring in somebody and talk a little bit about it. But we're going to make the Zoom platform, we're going to make the YouTube channel a little bit more focused on our option trading overall. So thanks for the question, Wayne, and nice to see you once again out there. Thank you for going live. Appreciate that, Alyssa. Mohammed, Brian, how do you manage the trade? Okay, so my management of this trade is to be awake tomorrow, right? When the market opens, I want to be awake. I am not going to adjust this trade. If the market opens up the expected move, we're okay with that. That would be a nice move. So 136 points to the upside doesn't quite get us to our strike. We're landing somewhere in here. That gives us some flexibility. That gives us a little bit of time decay that we need in order to make this trade profitable. So ideally, I would like to open somewhere between 2,800 and 2,850 with the potential to drive forward, right? Now, if it ever gets between 2,900 and 2,925, it should be 2,915. Between 2,900 and 2,915, which is our short strike here, I want to consider closing it out. And you may not have as big a profit as you might think. Still, 1 day's worth of time value is a lot. And if you're closing out this trade, you're going to want to close this out. You're going to have to pay to close out these options. These two option contracts are currently trading for $11, that far out of the money. And the only way that we can be profitable on our forecast is if we get some of this time decay to go away. So to follow up on that, here's how I would manage it. I would legitly have a trade in, and we'll click trade here. After I executed the trade, I would want to have a trade in that would allow me to close the trade at a decent net credit. Now, the one thing that's wonderful about this, you are actually buying a butterfly for a net credit. Hard to say it that way. But so the buy to open becomes a sell to close. And if you are correct on your forecast, you can put this trade on for a net credit and you can close it out for a net credit. So the closing trade would be sell to close, and this would be buy to close, and this would be sell to open. Let me get the last one. Sell to close. There we go. All right. And that would be the right now we see we're trying to get this done. Well, actually, it's a little bit bigger net credit. Net credit was 105 when we looked at this. It's now 130. You'd be paying the debit to close it right now. We're going to be receiving a credit to open it overall. So I would have this trade in here, and I would say, if I can close this trade, and I would just have it live after I execute it, want to execute closer to the close today. And I would be looking to try to close it at a net credit of, let's say, $2 to the account. And I'd be prepared to adjust it. I would just keep that live in the account. I'm not looking for a home run. If you think you're going to make 15 on this trade and close this out for a 1,000, that means it had to stop right at your short strike, right at expiration. Very hard to do overall. That's how I would manage this trade. I would keep that out there. I would adjust it. Market opened up anywhere close to the 29.15 level, which I don't even know exactly how many points that is, but that would be way more than the expected move. I would get out of the trade and I'd probably be down on it. I want to manage my risk overall. I have three scenarios that work here. Market stays the same, goes up a little bit, goes down. All of those scenarios would make me profitable on this trade. And then I have one scenario where I could do really well. And I have another scenario where it just stops right around the 29.15 level at expiration. And I have a real bad scenario if the stock market or if the Google stock overall opened above 29.45. That is my worst case scenario. And we're showing it right here. Maximum loss on the trade would be $15 minus the $1 net credit that we brought in. We'll call it 135. I guess that's where we're at. 135 will be the value that we will use on Friday stock play of the day overtime. It'll be a very interesting overtime because we'll know what has happened on the trade. Okay. Good to hear. No other questions in the chat box. Your last chance to do this. It will be fun because we're going to learn so fast about this trade because they will be announcing earnings after the close. And if I look at my watch, we're right at 12:30. Thank you so much for coming for today's stock play of the day. We're not always going to be this advanced, but I appreciate you hanging around and watching. Please share with everybody. This is free for all, the stock play of the day. Tweet about it. Let people know a little bit about this. And click subscribe, ring the bell, and hopefully we'll see you this Friday on the stock play of the day overtime. Thanks for coming, everyone.